Hi, and welcome to the Macro Show. We talk macro, and you wonder, does a big payroll miss really threaten the economy? Well, not according to the stock market, it doesn't. We've got that. We've got the pandemic unemployment claims, dealer statistics, labor force participation rate, non-farm payrolls, and we got the credit data and an update from compliance on Momentum Timer Pro. Now, before we get into our headline story, this week I sat down with my friend Corey Cleveland for an interview about business-related stuff. Now, this is kind of different. It's an interview. It wasn't a macro story interview. It was about my thoughts in terms of being in business, what business owners face, and we got into some really deep stuff. You're going to learn about the history of the Macro Show, how it started, all the challenges I faced with it, things I've faced in business over the years, things I think business owners face, risks they face. And you're going to learn a lot of personal things about the Bond King himself that you never knew, that only a very small circle of people know, and how I overcame those adversities. Now it was a 2-hour interview, but it's going to be broken up into 2 parts coming out next week. So I'll get you a link on that when it happens. All right. And really what that interview was, it was really a tribute to all of you, because the success of the show, I wouldn't be here if it wasn't for you. So thank you. So I hope you get a lot of enjoyment out of that interview. I know I had a lot of fun with him as well. All right, so let's get into the economic data. The headline story is what's going on with this payroll report. Now, we had a big miss. We'll get into the actual numbers in a little bit. Odds are you probably already heard what they are. They was terrible. And the revisions from the prior week, terrible. And the initial reaction from the stock market was stocks went down and bond prices went up. And you'd think, oh yeah, that's exactly the way it should be, right? Because you have 1 million payrolls the week before or month before, and you have sub 300,000 in April, and it tells you the economy is not recovering. That's got to be bond bullish. It's got to be stock bearish. Yeah, and you can take that crown right off, because minutes later, stocks started to rally and bonds sold off. Now, why did that happen? Why is that? How does that even make any sense? Well, here's what I want you to think about. Is it bad for the economy? Does it say the economy is in a weak place? It does. But the stock market doesn't care about the economy. It stopped caring about the economy a long time ago. All the stock market cares about is credit. And as long as the Fed is going to maintain an easy monetary policy, which it is, and we heard the Fed say that, as long as employment data is not back where it needs to be, we're not going to change anything. And here's what the stock market cares about. Now, this is not current. It's as of April's. When did this come out? We'll not worry about that at the moment. It was early in April. And you can see in red, this is a margin debt. Record all-time high. Now, why does higher interest rates threaten margin debt? Because then people can't make their margin loans. They can't pay on it, and you get unwound. So what does low interest rates mean? Borrow more money, borrow on margin, buy more stocks, keep the rally going. The stock market doesn't care about the fundamentals. It doesn't at all. Now, why would that be bearish for bonds? Because how do you get more money if you're tapping out your margin loans? Well, you can go short the bond market, sell some bonds, go out and buy stocks. Take the profits from the selling of the bonds that you don't own and buy stocks. So that's how the market reacted, is that this is good news, because that mountain of debt, well, not coming unwound at least anytime soon, according to it. Does it matter that stocks are overvalued? Not to it. All it matters is, can you go out, borrow more money, and buy more stocks? And that's what it cares about. Now let's take a look at the economic data, because there's some really interesting things as we get into this employment data that really don't make any sense. And you're going to see that the economy is super weak, and at a time really shouldn't be. So let's go to the economic data and kind of move through where we were. Let's see, on to Thursday. Was there anything here? Nope, nothing in Wednesday of interesting that we didn't cover already. How about we go out to Great Britain? We have the services PMI at 61. For April, prior month 56.3. So we already know the services sector in Great Britain expanded at a faster rate. That's good news for them, as did their composite PMI. Let's keep moving along. Retail sales in Europe, year over year, in March, up 12%, phenomenal. But the big number here is a month over month, 2.7. That's a big number. Now, it was 4.2 the month before, which is huge. But when you get big month over month numbers, you can support big year over year numbers. So that's good news for the Eurozone in terms of retail sales. That would be for March. Now, we have heard that the Bank of England and also the Bank of, I don't know if it's Bank of Canada, I think it's Bank of Canada. Anyways, they have trimmed and they're started to taper their QE purchases. Now, a lot of people believe that the Fed is going to taper. They're going to start, or soon, starting next year. I think the rumors are that this summer the Fed is going to start to talk about taper. This payroll report put an end to that. The Fed historically has actually not tapered or raised rates until after everyone's back to work, lost their job. So when we hear Fed Chair Powell say that that's the plan, that's history. That's the truth. That's what the Fed does. So this view that the Fed was going to start tapering and cutting their bond purchases, you can just throw that right out the window. That's not going to happen at all. Now we get into Thursday's data here from the U.S. and we have the unemployment data. Let's go to the Department of Labor and some really good news. We saw initial claims go from 590,000 last week, which was starting to trend higher, to finally under 500,000. Now, I want you to think about this number for a minute. It's at 498,000. And what are we hearing from employers? You can't get workers, right? There's a shortage of workers. I need workers. Now, if the normal unemployment run is between 200,000 to 300,000 in a healthy economy, and employers are allegedly desperate for workers, shouldn't we see that number perhaps on the low side, the low 200s, even maybe under 200? Would make perfect sense that we see that. But at around 500,000, what is it telling you? That employers are saying, look, we need all these workers. Well, maybe they don't need them, even though they're acting like they need them. And that should be really troubling, the fact that we're still seeing these elevated amount of claims. Because again, employers, everything we see in the data says, and we see in the surveys, it says we're short workers and we need workers. And yet, employers are still laying off. Let's go down to the pandemic claims, dropped 404,000 to just a little over 16 million people. Now, if you want to know where I got my claim of what I thought the non-farm payroll report, we talked about this on Wednesday, I thought it was going to be 1 to 1.5 million. Now, if you say, well, where did you come up with that number? Well, simple. We had 18.5 million people filing for pandemic claims, and now we're down to the low 16s. So what would that tell you? It's about 2.5 million. Well, we had 1 million people hired in March. Should be 1.5 million people in April, right? Makes perfect sense. So what are we actually learning about this data? What we're learning is there are people, and I'm not the foremost expert on unemployment claims because my understanding is they got extended till September. Now, perhaps that is not for everyone, as I've come to learn that doesn't apply to everybody. There are people that are at the end of their term and they're falling off. So based on what we know from last month's payroll, right now there's 1.5 million people who are off unemployment claims that have no income. That is another problem. The market deems this as bullish, right? So you go and look at why did stocks rally? You come back to not only is it credit data, it's the fact that the market thinks there's going to be more stimulus. There's going to be more government handouts. Now, what is the reality of that? Well, who passes that law? Who makes that decision? Congress. And right now, they're indecisive about what they're going to do with an infrastructure bill if they're going to get that done. The chances of there being any more stimulus anytime soon is pretty close to zero. And what are we already learning about this direct stimulus? It's not creating jobs. It's not leading that. We'll get to the job creation part here shortly, but it's not creating jobs because why are people going off their unemployment and not getting to work? And why are people at work losing their jobs if there's this huge demand for labor? Something isn't adding up, and we're going to try to get to the answer to that. So let's go back to the economic calendar here. We noticed the 4 and 8 week auctions were strong, nearly at zero. Strong demand for T-bills. And let's take a look at the primary dealer statistics and look at T-bills. They went from 43 billion down to just under 19. So huge demand for T-bills from out of the primary. This is the primary dealer banks who are the warehousing, and that's their job is to buy securities and treasury securities and sell them off. How about 2-year? They went up to almost a little over 54 billion. Now keep in mind there was a 2-year auction last week, but you could see 54 billion is toward the high side recently, so there's not much demand. these 2-year notes, which based on what we know the bank should want, there should be a ton of demand. How about 3-year? They're small inventory, $2.5 billion. 5-year, there which we had an auction last week, just under $9 billion. 7-year, we had an auction last week sitting at $8 billion. So there's not a lot of inventory of those either. And how about we go into the 10-year, just a little over $1 billion. And the 20 and 30 year, which I wish they would break apart so we could see that, still sitting just a little over 41 billion, which isn't neither high nor low for the 2 long bonds in this equation. So we see there's a lot of demand for Treasury securities, particularly T-bills. Let's move on here to, to Japan services PMI late Thursday night. Went from 48.3, which is a slight contraction, to 49.5, virtually unchanged. So no improvement in the services sector out of Japan. Let's go into today's data, and let's see exports and imports. I'm really always interested in these. They do show if there's an expansion in the economy, and both imports and exports for France expanded. So it says their economy grew between February and March, which is something we already know. It just validates the information that we have. Let's continue on to China. All right. So imports year over year up 43.1%. That's huge. Exports up 32.3. Now, I want to talk about this export data because a lot of people think, they're still worried about these treasury auctions. And next week, we've got the 10 and the 30 coming. And there's some, you just saw the dealer data. So it tells you that there's not an inventory problem there. But there are people that think that, okay, there's going to be, still a rejection of these auctions. But keep in mind, when exports to China go up, what happens, right? There's some of those goods and services, generally a lot of them, come to American shores. And how does China and other countries that export to the U.S. get paid? What do they get paid in? Not cryptocurrency, they get paid in dollars, right? They get paid in dollars. And those dollars go from the U.S. all the way back to, China or what other country the goods and services came from. Those dollars then get recycled back, not entirely all of them, but get recycled back to the United States through treasury auctions, because as they pile up too many dollars in their offshore accounts, it becomes inflationary to that country, so they cycle back. So when you see a big surge in exports, and you know that the United States is the largest importing nation in the world, and their job as a country, our job is to export those dollars, you don't have much concern about demand for treasuries when you see this data. So there's nothing but positive news that says that the coming treasury auctions should be A-OK. Now let's move into the non-farm payroll report. And let's check this out because it came in at 266,000. Remember, I thought, 1.5 million makes sense. Everyone else said 1,978,000. 266, what's even worse is the prior was revised lower, 916 down to 770. And the week before that, or the month before that in February was revised higher from 379 to 468. Overall, this was pretty bad. And so you start to think about what is really going on here. And one of the views I have is employers don't really want to hire as much as they claim they do. Now, I've received some feedback from fans that have said that, hey, there's a lot of job openings, but companies really don't hire. They said, Steve, you don't understand. They use some of these websites, these job websites, and they keep jobs open out there just kind of as a marketing tool, just to keep their presence there. And some of the feedback I got was, I had people email me and said, hey, you know what? My company has job postings on there. We have the same job posting. We always have them on there. Yeah, we get resumes for them, but we don't actually interview. We're not hiring. If you read the description, they're so ridiculously difficult to find someone that if we actually found someone that had all those qualifications, we probably would hire them. But we already know they don't. And then I heard from other people, yeah, we have continuous postings too for jobs, but we never interview. They just sit there. We keep them active. If you go look, they've been on there for years. Again, it's more of a marketing issue for these companies to keep a presence on these websites. And then if you break down into the non-farm payroll report, you find that about 115,000 jobs were lost from recruiting companies, from job recruiters. So if there's all this demand for the companies to hire, because they're all waving their flag saying, hey, look, we have 6 some odd million jobs open. If you look at the JOLTS data, Maybe we have 6 million jobs that we're looking for people that don't exist. But if all these people needed jobs, then why are recruitment centers laying people off? Something isn't adding up. And so if you really start stepping back from this, what happened with the first stimulus, right? The economy was going on, it had the stimulus, and it gobbled it up. It went through. And then the second stimulus came on, but it wasn't really big. I mean, compared to this last one, right? Remember the one in December? It was pretty small, and the economy handled that. And then comes the big stimulus, right? The economy's got to get way over that. And what did it do? We hired some people on. But companies are not excited about hiring too many people on. Why? Because they know these are one-time checks. And if they can absorb this big demand with the workers they've got, it's to their advantage. And they're not convinced there's going to be more stimulus. They're not convinced there's going to be a follow through of demand. And if we have people that are not going back to work, and we have people that are falling off the unemployment benefits, what's happening to their income? It's going down. And what happens if their incomes go down? It means demand's going down. Now, I know there's other issues here. My wife, who is in charge of all educational related things around the house, because she's a credentialed teacher, says, look, there's still an issue because schools aren't completely open where kids are back full time. And so, yes, there are child care related issues. I do agree with that. Other question is, why aren't grandparents and other family members stepping up to this plate and taking care of that to allow people to go back to work? We've seen a lot of older people retire. What's going on? Things are not adding up. But this payroll report, absolutely terrible. And it just tells you that employers do not want to hire. They're not interested in. And let's look in here. Manufacturing payrolls down. Government payrolls up. And at some point, these government payrolls are going to drop down due to a lot of the vaccine centers closing up. Private non-farm payroll is up 218,000. How about the unemployment rate went from 6 to 6.1? Again, you're not going to see the Fed tighten policy under these conditions. How about the participation rate? Now, what is a labor force participation rate? It is the percentage of potential workers who are either already employed or are looking for a job. And what you want to do is see this number go up a lot. It went from 61.5% to 61.7%. Now, where is it at in a good economy? Well, here's the labor force participation rate in blue. And it was a really strong economy, the late 90s, 2000s. Well, you're up in the 66 to 67% range. Where are we at? Again, 61.7. And I've overlaid the monetary base and inverted it. And what you can see is the negative effects of quantitative easing. Remember, we talked about that dollar prison, how it ties up dollars in the banking system. The Fed is getting ahead of the curve now, which is interesting. We see it in bond prices. The Fed is starting to get ahead and win. And for that, well, we will go back to the crown. And so what does that suggest with the labor force participation rate? It means that what we're seeing in the non-farm payroll report is bad news, right? I thought this was going to be the peak month. I did not think the prior month was going to be the peak. So this is saying that people are going to likely get discouraged, look for work, people that have work as demand drops down. And again, why is demand going to go away? Think about that. At the end of last month, what did we know about the checks coming out? There were 85% of them were already done, leaving 15% of all remaining stimulus checks to get out this month. That's not a lot of demand. And what happened, right, and if we look at the demand for money, is growing more proportionally than the money supply. And so even in March, we saw the money multiplier decline. What is it likely going to happen in April? It's going to decline. And then by that point, it's game over, because there's no more stimulus, because now, so what are you going to expect in May? A further decline. This is very disinflationary. Yes, I know the consumer price index is up. It's still very, very disinflationary. And at some point, this will come around full circle. How about we look north to Canada? Full employment change down 207,000. So that's not good. Again, we're looking for big numbers here, people going back to work, not numbers going down. Perhaps Canada should reconsider tapering their QE program. Participation rate fell 64.9 for 65.2. Up there, unemployment rate went to 7.5 to 8.1. Again, it's almost as if we've put all of the stake on these stimulus checks, and we're seeing the employers just are saying, look, I'll get through this. And yeah, there's some employers that legitimately need workers. We know that. But apparently there's a lot of other ones said, yeah, we're calling the bluff on this. Demand is going to go away. We've seen this through the last 2 stimulus checks. We know this one was big, but the demand is going to go away. Because remember back in February, right? Checks, the stimulus passed in December. Checks went out in January. Boom, recessionary data in February. What do you think is coming for us? We already know. All right, let's go and see what else we have here of any real interest. Consumer credit, this is back as of March, but we already look at the weekly data. Speaking of the credit data, let's get into what's going on today. It looks like some positive news here. Bank credit up $25 billion. That's good. Securities and bank credit up 13. Banks continue to love mortgage-backed securities up $15 billion, while they shed some of their U.S. Treasury securities by $5 billion. Loans and leases, all commercial banks, that is up $11 billion. Commercial industrial down are up 1. Real estate loans down 2. So we're seeing people continuing to pay down on their real estate despite a lot of people borrowing money out of their houses. Consumer loans up. Hey, the consumer's back at $6 billion. Quite a bit of that just in credit cards. And then, of course, we know automobile loans are up. Makes sense. Cash assets at banks up $148 billion. Whew, that is huge. Again, all that cash pile up. Guess what needs to happen to it? Banks are going to have to buy bonds to back it. How about here? Let's look at the charts. Real estate loan growth down 1.21. The 9 should not be there. 1.21% from a year ago. Again, telling us what we already know. Rates are too high. The 6-month rate of change is falling. The 3-month rate of change is rising, but it's still negative. How about commercial industrial? We need this one to really turn around, but so far it's not. Growth rate's down to 15% from a year ago. The 3-month rate of change is still close to 0 at 0.57, but it's still trending lower. The 3-month rate of change is the leading indicator here. How about loans and leases at all commercial banks? Growth rate down to 4.62%. The only good news is, thanks to the consumer, the 3-month rate of change is effectively at 0 and rising, but the consumer alone is not strong enough to keep this trend alive. Here we see credit card loans up 4.2% from a year ago. Stimulus is certainly helping. That easing of lending standards to consumers on credit cards is helping here, but still down 4.2% from a year ago. All right, on to Momentum Timer Pro. So a bit of an update. Everything I do due to my license has to go walk by compliance, get their approval. And because we changed and added some timing indicators, that was kind of a surprise to compliance. And so I needed to give them some time, and they came back and said, all right, we're going to give you the green light to go to the next step. We're okay with this. We understand what you're going to do with this. We're okay with our disclosures. So now the next step is I got them put together a landing page and connect it to the email, and then they got to review the website, which won't have much on there because I'm going to give this away for a while. That was the plan, is to let you see how it works, get your feedback, see if we improve it, what needs to be done. If it doesn't work at all, if you don't like it, then we'll scrap the whole thing. And if it works and everyone likes it, we're going to come out with a very reasonable price point down the road and issue that out. So the next step for me is I got to put together a landing page, which I've got the tools to do that, connect to the email, and then let them look at that. And once they sign off on that, then we're probably a go. So anyways, it's still the same as I think you saw it last time. It's got some monthly, quarterly, and biannual signals here, and then it's got position sizing. For those of you who have struggled with, how big of a position do I take? And I've got to build out some notes on how that all works. But anyways, cool stuff, and I've been following it. I love the accuracy. It's definitely a macro newsletter. So keep that in mind. Anyways, I hope you have a great weekend. Thanks for being fans. Thanks for supporting my show. And wait till you get to hear that Corey Cleveland interview. You're going to absolutely love it. Anyways, I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation of buyer selling a security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity opinions expressed in this video that do not reflect the view of Atlas Financial Advice, Inc. or Steven Van Metre Financial.